Alright, welcome back to another episode at Economics Design. As you can imagine, we're going to dive a little bit more into stablecoins this next few months. We talked about Faye the last time, and today I want to talk about the other types of stablecoins out there. There are a lot of innovative ideas, and there are a lot of very interesting mechanisms to create these stablecoins. And I think stablecoins are going to be very important. I think a lot of investors are not so keen on stablecoins because you don't earn as much, but I think they form a very important foundation to growing the ecosystem and to allow more people to come into the DeFi ecosystem. So I think stablecoin is very interesting, and I definitely want to talk a little bit more about stablecoins. So today we're going to talk about Alchemix, the economics of Alchemix, and how it is a no-loss stablecoin. Again, disclaimer, this is not investment advice, this is purely educational, and opinions are my own and not representative of the company. What we're going to cover today, we are going to cover what is Alchemix Finance, how is the stablecoin created, how do you maintain stability, how is this stablecoin different, as well as some thoughts and opinions.
The idea got started probably back in 2018. At the time, there wasn't really any DeFi, but one of my friends who I had met in a crypto Discord, he had played around with some different dApp ideas, and he had made some really small ones. And one of those was this kind of project where it was actually kind of similar to Alchemix, but it didn't have DeFi, so it didn't have a stable source of income. So eventually, it kind of ran out of steam, and it couldn't continue anymore. But the creator of that app, who's a CTO of Alchemix, he kept on thinking about it, and then in June 2020, he approached me because he knows that I'm a front-end developer. And he said, okay, I think I got it. I got this new app. It's going to be really cool. And I need you to build a front-end for me. And I've been looking to work on a crypto project at this point. I've been doing mostly Web 2 stuff. And so I jumped in and I started working on it. Back then, we were called CheeseFi. And the idea for CheeseFi is kind of similar to Alchemix, but not as good. The idea is that you would lock up your DAI for between 10 and 100 days, and then immediately get cheese tokens in return for that. And then those the DAI would then go into yield aggregators. Like at the time, we were going to use Idle because that was the only one that existed. And then take the yield from the DAI deposits and then buy back the cheese tokens from the market to create this kind of pseudo yield token that you could get upfront. But then we did some more research and we dug into the mechanics of all this, and we learned about the minor extractable value problem, specifically sandwich attacks. And sandwich attacks could be devastating to the CheeseFi model.
Alchemix. What is Alchemix? Alchemix is a stablecoin that uses DAI as collaterals to create this stablecoin. So it's another stablecoin protocol. And I think the very interesting thing that is in this protocol that I want to talk about is how it includes real inflation. It includes real growth in the ecosystem, which is why it's quite different. And it talks about capital efficiency as well. I've been saying quite a few times now that when you first enter the system, when the entire DeFi ecosystem is growing, you don't think so much about capital efficiency. You're thinking about over-collateralization, you're thinking about risk management, you're thinking about yield. Today, things are a bit different. We have grown so much further, and we can think a little bit more about how to efficiently use our capital to get more returns than just over-collateralization. So this talks a little bit about it. There is some over-collateralization in the Alchemix protocol, but it also uses your collateral ratio or your collaterals to help you to earn some form of yield. So in that way, it kind of offsets it quite a bit. So we're going to talk about that later as well. And how I see Alchemix is really an evolution to what DSD and ESD is doing. So DSD and ESD, if you remember, is the empty set dollar and dynamic set dollar. I think the mechanism was very interesting, where it uses the kind of government bond-like strategies to create and rebalance to get the stability of the $1. Now, the problem with ESD and DSD, although super innovative ideas, is that it was just level 1 to innovation. They had a great kind of concept, but the execution was not as robust, was not as good. So I see Alchemix as a way to make it better, as a way to evolve to level 2 of what crypto bonds could be in terms of a stablecoin. So I thought that was very interesting, and I wanted to share that with you. So let's go to part 2, stablecoin creation. So why is it the fact that it's 200% over-collateralized? How does that help with making sure that it's a no-lose stablecoin mechanism?
So if we had a lower collateralization ratio, loan repayments would take a lot longer. Right now, with our current yield, it's around 2 years to get repaid. But if we had lower collateralization ratio, that might take 5 years. It might take 7 years. It might take 10 years or something like that, especially if yields start dropping in DeFi. And I thought that would be, that's like a lifetime, especially in DeFi and crypto and stuff like that. So I think having such a long repayment time is a little bit unrealistic. A lot could happen in that meantime. And the other thing is that what people can do is they can, let's say you borrow ALUSD, then you sell your ALUSD for DAI, then you put it into Alchemix, then you borrow more ALUSD, and you can do this loop. Right now, because of our collateralization ratio, it means that you can basically lever your vault up to 2x. If we had a lower collateralization ratio, this kind of recursive strategy could be exploited even more. And we don't think that would have a good effect on the system overall. And it might destabilize the peg because people would over leverage their vaults and stuff like that. So in order to, for health of the system and for reasonable debt repayment times, we set the collateralization ratio to 200%.
How is stablecoin created? Firstly, you use DAI to create USD. And now you're thinking, okay, DAI is basically one USD. I'm giving USD to create USD. Why don't I just use DAI in the first place, right? Yeah, that's true. It works in a very interesting way. So the high level way is, let's say I have 100 DAI, so $100. I give it to the Alchemix protocol. And when I give 100 DAI there, I get to borrow 50% in LUSD, so the Alchemix USD. So in the system, 1 LUSD is always equals to 1 DAI. And in this system, I am 200% over collateralized, right? Because I can only borrow 50% out. So I'm 200% over collateralized, which is a lot more than Maker, because in Maker is 160%. Here is 200%. So I get to borrow 50% in LUSD. And what is the protocol going to do? The protocol takes my 100 DAI and it uses that 100 DAI to generate yield. So it takes the 100 DAI, goes to stuff like Yearn protocol. Actually, they work with Yearn protocol, deposits the DAI in Yearn to get YDAI, and it allows it to generate different kind of interest and generate profit and yield from there. So right now, Yearn is charging about 13% APR on the yields generated based on whatever strategies that Yearn Finance is doing. So when you put 100 DAI in general, you can take 50 LUSD, which is equivalent to 50 DAI out, spend it wherever you want. At the same time, during that 1 year, it generates about 13 DAI out of your 100 DAI that you put in. So that's the general idea. And what it does is that it helps you to pay off that debt or that amount borrowed. So we have 100 DAI, we took out 50 DAI. We took out 50 DAI in LUSD, right? So you have 50 remaining that you need to pay off. So this entire system, this entire mechanism helps you to pay that 50 DAI off through this yield generation. So this is where the whole capital efficiency comes in, because your capital is being used to generate yield somewhere else. So how does it maintain stability? Because it's a stable coin after all. Price slippage happens because there isn't enough liquidity, or rather because it isn't one market maker doing all the trades. It's always trading with a liquidity pool. So it's a pool of everyone's money in there. That's why any significant movement can cause quite a bit of price shock or price volatility to any trade. That's why you want to reduce such risks.
Yeah, if you use some different DEX charting tools, like DEX tools is one that I really like. And you go to like a pair and you can watch the trading feed, and a lot of times you'll see like a little like red hat like hacker icon and next to a trade, and that'll signify that was a sandwich attack. So you can like see it and be like, oh wow, that person just made $500 doing this attack and without risking any capital whatsoever. So it's cool and it makes me want to run one of these bots, but at the same time it kind of killed the idea for CheeseFi. So we went back to the drawing board. And at this time, our team had expanded. It wasn't just me and the CTO anymore. We added a couple other smart contract developers and another front-end developer. We had an analyst. So the team was like at 6 people at this point. And we kept on iterating until finally we got to the Alchemix system. And that kind of avoided the whole AMM problem altogether and allowed us to not only deliver future yield to you now up front, but also we could do it in the form of a fungible stable token.
Here, the big picture, the general idea is that there are 2 big pools. The first one is the collateral pool. So you have your DAI, And you take your DAI, put it into the collateral pool to get LUSD out. So that's the main mechanism, right? Put DAI in, get LUSD out. Then you have another pool where you put LUSD in and you can get DAI out. So these are two main pools. The first pool is like the collateral pool. You put DAI in, get LUSD out, spend it anywhere you want. The other one is a transmuter pool where you put LUSD in and you get DAI out. So that's the general idea. And now, how does that work? How does that help with the whole stabilization method, right? Good question. So remember I told you, one of the key important thing in this entire game is that one DAI equals one LUSD. One LUSD equals one DAI. So if you're in that situation, sometimes prices change, right? It's not always one for one. So let's say one LUSD is now worth more than one DAI. Let's say one LUSD is now worth $1.50. That's a 50% increase. That's a lot of money, right? So how can you benefit from that? So people will put DAI into the collateral pool, into the first pool, you put DAI in there and you get LUSD out. And so because you put 100 DAI, you will always get 50 LUSD out because it's 50% collateral. And now because one LUSD is worth $1.50, then more people want to do that. And more people will turn their DAI into LUSD and increase the supply of LUSD and reduce the prices back to $1. So that's the general idea. So when LUSD is more than $1, more people put DAI in to get LUSD out, trade it in the secondary market or trade it anywhere you want because LUSD will always be equivalent to one DAI. So that's when LUSD is more than $1. When LUSD is less than $1, that's when you go to the transmuter pool. And what you do is you take your LUSD, you put it in the transmuter pool. And when the transmuter pool gets any returns, harvests any yield in DAI, you can always trade one LUSD for DAI. So let's say now your LUSD is worth 80 cents instead of $1. And you don't want to spend it because it's not worth that much. Nobody's going to accept it. So you take your LUSD that's 80 cents worth, you put it in the transmuter pool, and once the transmuter pool generates yield and generates more DAI, then you get to give them 80 cents worth of LUSD, you get one DAI out, which is worth $1, because it's always one for one in the system. So that's how it helps with stability, when LUSD is more than $1 and when LUSD is less than $1. So where is the fee coming from?
The fee is coming from Yearn. So your debt is getting repaid automatically through Yearn. Every single time we harvest, your debt goes down and there's no interest on LUSD.
So that means I put 100 DAI in, I take 50 LUSD out. And that means when Yearn makes any profits, any yield, the yield comes in to pay off that 50 DAI that I've borrowed.
The 50 LUSD, yes. Every single time that we harvest yield, then that will go to paying off your loan. Right now, it takes around 2 years for a max loan to be completely paid off.
Yep.
But yep, that's how it works.
So for anyone who wants to gain from being part of Alchemix, you either put DAI in to borrow LUSD out and allow the system to generate enough yield to be paying off the debt that you have. So you effectively get 50% of the amount you put in that we repaid in 2 years. Or the other way is when the transmuter is there and people put LUSD in to take DAI out.
Yeah, so if you're using the transmuter, the only reason to use it is if LUSD is off the peg. If it's not off the peg, just trade it on curve. It'll be faster, it'll be instantaneous. And the other thing is that the transmuter actually has a beneficial effect to the DAI depositors in general, because all the balance of the transmuter is also farming yield. So we have like 240 million DAI in the transmuter, and that's all farming yield. And then we have like an additional around $160 million or DAI in deposits in the vault. So in effect, we have 400 million DAI as principal, but that's only for 160 million DAI in deposits. Because of that, even though we're using Yearn and Yearn's rates are around 13%, we can offer around 30% because of that extra principal that's being passed on, and the yield from that being passed on to our depositors and helping to repay their debts faster.
So for all the yield that's coming from the vault, is it all to the vault or part of it also goes to the transmuter? So the transmuter effectively gets two types of income stream or yield stream. One from the vault, or one from excess from the vault, and one from the transmuter itself.
Yeah, the way it actually works is that we the transmuter has a vault adapter, and so does the Alchemist vault has a vault adapter as well. The way we do it is we harvest the yield from the transmuter, and then those YV DAI tokens, so the DAI vault tokens, then get sent over to the vault adapter for the Alchemist contract. And then that one gets harvested. And when that gets harvested, 90% of the yield is used for debt repayments and being sent to the transmuter. So those are one and the same. So if we have $100,000 worth of debt repayment, then $100,000 goes to the transmuter. And then 10% of that harvested yield goes to the DAO treasury. We've been averaging somewhere between around 150 to 200,000 DAI per harvest, which is a daily thing. So our DAO treasury is growing around $15,000 to $20,000 a day at this rate. And debt repayments around $130,000 to $180,000 a day.
That's very good money. Oh, that's very good yields coming in.
Yes, it's very good yield coming in.
So again, 90% of the harvest goes for all the harvest coming in, 90% of it goes to the Alchemix vault as well as the transmuter vault. Is there a percentage split between those two?
No. So imagine like you're in the Alchemist vault. You have 100,000 DAI in there. You borrowed 50,000 ALUSD, and a big harvest comes through. And let's say 500 of your ALUSD debt gets paid off in that harvest. Right?
Yeah. How do you determine that?
So what happens is like that amount of DAI is like from the harvest is kind of spread proportionally amongst everybody by the amount they have deposited into the Alchemist contract. And then that debt there is then deducted from your ALUSD debt is deducted from the ledger on the app. And then that DAI, all of that DAI is sent to the transmuter, which then becomes available for transmutation and also boosts the yields in the system.
So it pays off debt first before it goes to transmuter?
It's kind of one and the same. The Alchemist takes care of the bookkeeping as far as debts and credits and everything like that goes. But since ALUSD is our own coin, we're not borrowing it from anyone else. We created it. We can mint it. We can burn it, or at least the system can. Whenever we do a harvest, we just delete that debt from your own personal ledger, or at least we reduce it. Okay, that ALUSD isn't getting burned or anything. But if someone then wants to transmute the ALUSD that they have in the transmuter, then that burns the ALUSD and they can then receive that equal amount of DAI that they burned in ALUSD.
Got it. So the first vault, the Alchemix vault, is more of like a paper accounting, whereas the transmuter is where the actual, more of the physically digital or digital asset would be.
So the Alchemist is where you turn DAI into ALUSD, and the transmuter is where you turn ALUSD into DAI.
Yes, got it.
And I know it's very complicated. It's very confusing. It's something that's a little bit out there, but the bookkeeping does work. But I can reassure you on that.
Awesome.
So actually talking to you helped me explain it further on, because kind of distinguishing the Alchemix vault as that's where you create ALUSD. And then, DAI to ALUSD, and then transmuters ALUSD to DAI. Just summing it up that simply is actually going to be very helpful for me going forward.
Yeah, because I was trying to understand how it works as well. Because initially I thought that the first Alchemix vault is where you change DAI to LUSD, and then you have to pay some interest on it, just like ETH to DAI. And then any yield comes in will be repaying that interest. So you can always change it back to your DAI immediately by closing your vault. And then the other transmuter is like an additional rewards pool where additional rewards just goes in. But what you're talking about, it's a very different thing from what I understood. So thanks for clearing that up. So one of the rewards in providing liquidity and using the system is the ALCX token. What can people do with that token?
So ALCX right now is the governance token for our platform. We've had a few votes so far on Snapshot, and we have a developer and community multi-sig wallet. That's a 5 of 7 multi-sig, and we have 4 devs and 3 community members on that wallet. So we always need, at least one community member to go along with the devs to get anything done. And there's also a 24-hour time lock on that. So there's some different security layers to make sure that nobody from the team or the community wallet or the multi-sig can do anything malicious. And it'll be easily spottable if we do try to do something like that. Not that we would, I value DeFi and Ethereum, and being in this space, it means the world to me. I love it. And I would never endanger, that because I'm being selfish or a crook or something like that. So we're not going to rug you guys, but that won't be an issue anyway going forward. When we're working on our version 2, and with it, we're going to be releasing Alchemix DAO. And that will get rid of the whole snapshot with a multi-sig wallet and turn it into an actual DAO that executes code. And we won't have that kind of power anymore. We're going to be trying to decentralize in that respect.
Fantastic.
So,
that's a good shift. I think everyone starts a bit more in a centralized way, just to get this infrastructure in place and try to get the foundation right. Then it slowly decentralizes to allow the community to manage. That's like the perfect usual transaction.
If we're making any big changes, we want to get the consent of the community and the token holders before we do it. But for like minor decisions and things that we just need to do and get done, I honestly, in my experience in DeFi, I've been in DeFi a long time. I noticed that like voter fatigue kicks in, like an apathy kicks in really, really, really quickly. And more so in projects that have votes that come up like every few days or every week. I start tuning out. I'm like, I go to my Discord and I see like 10 notifications from this project. What is going on here? And like it becomes overwhelming. I can't keep up with it. So like at that same rate, like we've been trying to be governance limited. Like if there's something big, or something urgent, we'll consult the community, but we're not going to bug you guys over little things like every day, at least until the DAO is out. And then that'll be the community deciding everything at that point.
Fantastic. Is there anything else you want to add?
So the ALCX token, so right now that's being heavily incentivized. So you can farm the ALUSD3 curve liquidity tokens. You can farm ALCX with that. You can farm it with the pool 2, which is ALCX and ETH. That's on SushiSwap. You can also do single-side staking with ALCX, which will be turned into the DAO. So the DAO will combine getting ALCX rewards for depositing, but you'll also get revenue from the system as well. So you'll get, multiple income streams.
Which is a 10% of yield coming in goes to the DAO, right?
Yes.
Okay.
Yeah, so you'll get ALCX rewards and more on top of it in the DAO. So that should make it a more attractive hold going forward, turn into a cash flow token in addition to being a governance token. It's also being integrated across DeFi. You can use it as a collateral asset on Ruler Protocol, Margin Swap, Rary Capital's Fuse pools, Unit Protocol. So you can borrow, assets using ALCX across all those different things. So it has a little bit of a capital asset is being accrued to ALCX as well.
Fantastic. That's super exciting. So what's the difference between this and other kind of protocols? This system was kind of like a bond system, like a currency bond system. If you think about what you're doing, you're actually giving your tokens, your DAI, you get to borrow some part out of it, and you get to use it right now. And who is going to repay the amount of money borrowed? It's through the yields generated in the future. So what you're really bringing is you're bringing forward the future revenues earned, the future profits generated, and you get to use it today. Again, you've got 100 DAI, you put 100 DAI in the system, of which you can borrow 50 LUSD out, you can use it today. So you effectively have 150 DAI worth of tokens. Then that 100 DAI that's in the collateral will help you to earn different yield and help you to repay that 50 DAI out, that 50 LUSD you've borrowed. So in that case, that's how you get to tap into the future profits generated. And one of the big difference is that there is real value inflation in the system. Remember, one of the things that I keep talking about in all the other protocols is that when we talk about inflation in the DeFi space, we're talking about inflation in terms of real value inflation and not just monetary inflation. It's not just inflating your tokens. It's not just inflating the number of tokens you have. Sure, you can keep doing that, but what is supporting the price of your token? You need to have supply and demand, basic economics. With the supply side, it's quite easy. With the supply side, you just keep increasing the number of tokens out there. But if you don't have the demand side of it, there is no, what is substantiating that value of the new tokens being added into the system? There is none. But here, they do that. They do that because with Alchemix, when your collaterals are being added into the system, it's actually working for you. It works for you in Yearn to get different kind of returns. Then it gets added into the system, and you can trade your LUSD out and get DAI. So in that situation, you're adding real value into the system, real economic value into the system, instead of just increasing and inflating the supply of tokens. So I thought that was a very interesting thing that, I've been talking about it for so many videos now, and an example of a protocol doing that would be quite interesting. The other thing that's interesting is that it's backed by correlated assets. So there are a lot of other stablecoin systems out there, like Maker, like Frax, like Fei. You're creating a lot of tokens, you're creating stable tokens, but it's backed by an uncorrelated asset, like ETH or RepBTC or Yearn, like YFI token, whatever kind of tokens. With this system, with Alchemix, it's backed with 100% correlated assets, which is DAI and LUSD, which is worth the same thing. So that is a kind of a different system.
People, they always know that I'm guaranteed that I can get one DAI for my LUSD. 1-to-1. Now, in a situation where, let's say, the peg is broken and the transmitter runs out of its reserves, okay, at that point, then if you want to use the transmitter to convert your LUSD to DAI, it might take longer. Right now, it's pretty instantaneous because the amount of people who are staking in the transmitter is relatively low. It's actually less than the amount of yield that we make daily. So it's very easy for people to use the transmitter if they want to and for their position to fill up. But in the case where we didn't have our peg broke and the transmitter was drained, then it would basically take however long it takes for the yield to drip into the transmitter for that LUSD to DAI conversion to take place. So when we're on peg, it's like as if we're a stable coin. And if we break the peg, then it's more like LUSD becomes a bond.
Understand.
But you always have the guarantee that it will be redeemable for DAI 1-to-1.
It might take a longer time, but right now it's instantaneous that you can just take it 1-for-1.
Yep.
I understand.
Exactly. So theoretically, it should be impossible to lose money using Alchemix. You might lose a little time value in the worst case scenario, but you shouldn't lose even 1 penny.
I understand. So how is it like a bond? How is it like one of these ESD or DSD systems? Well, with ESD and DSD, you realize that when prices are below $1, what do? ESD and DSD, empty set dollar and dynamic set dollar, they will take your tokens, they'll keep it onto different kind of epochs, and then once there's value increase, the value goes to you because you get to keep your tokens. That's the general idea, and the general idea is good. Now, the problem is when I say that when the additional tokens created. In the ESD system, which is like the bond system, when additional tokens are created, they're created from thin air. They're not backed by any value. So when it's created from thin air, it's probably worth nothing. And when it's worth nothing, it's given to the user, and the user now has a lot more of nothing. So, and then when it's nothing, they will dump it, and it worsens the situation. There are also a lot of whale activities that can do that. The new token inflation, the supply inflation, is not backed by anything. Whereas in this system, it's quite different. In this system, the new supply added into the space is backed by the yields generated through reinvestment of your collaterals. So that's quite of a difference, and I think that's a good way forward. How it's like a bond system is really like how government bonds work. With government bonds, you basically give money to the government, and the government will take your money, they promise you X percentage to return to you, and they will use that money to go and build roads, build housing, improve the economy, and then the economy grows. In this situation, it's a smaller scale where you give money to Alchemix. Alchemix forwards you the repayment, saying that this is what you can use right now, and I'll use the collaterals that you give me to go and generate some yield, and it'll be added back into the system after. So it's kind of like a bond system in a different kind of situation or a different kind of context, a much smaller context. And this is a bit more robust than the whole ESD and DSD system, which is basically one of my opinions and thoughts about it. So firstly, it's a very novel idea. It is all about yield generation, real yield through value being generated. So when we talk about capital efficiency, this mechanism, these collaterals, these capital that you're giving to the system is helping you to earn something. It's being allocated to add value or to create value in the system. And the way to create value could be via Yearn, which is through lending on various kind of platforms or generating yield in very different ways. And that's why DeFi is like this little Lego brick, right? You have different kind of protocols doing different things, you mash them up together and create new kind of products and services offered to retail people. So that's the general idea. It generates yield and use this yield to substantiate any new supply inflation in the system. It is also an upgrade of the ESD bond mechanism that I've talked about, similar to the bond mechanism of ESD where it adds in new kind of assets into new inflation into the system, but instead of supply inflation, it's adding value inflation or price inflation into the system through the yields generated. However, there is a limitation. And this is the limitation that is the common argument that you can keep saying in the collateral-backed stablecoins. It could be on-chain, off-chain, doesn't matter. As long as it's backed by collaterals, this will always be a limitation. Because this was the limitation when we moved away from the gold standard. Remember the Bretton Woods gold standard? Long time ago, when the US economy started, when a lot of central banks started, they backed their currency with gold. When the financial market just first started, that's like, hey, that's a good idea. I like that. Let's continue doing that because gold is safe, people use gold, and there's a value that people give to gold, which is quite high. So with that, you can continuously print money and allow the system to grow. So that's all very good. But do you realize that the economy is so much more than gold? The economy can scale so much faster, so much quicker, and in such a big volume that there will not be enough gold in the world to back the economic value that we are creating in our economy. And that is the biggest limitation to collateral-backed stablecoins. I really think that the future is not about 100% or 200%, especially in this system. It's 200% backed, which is a huge amount of money, or a huge amount of capital inefficiency. Yes, the capital is earning money for you because you're using the collaterals to be earning money for you, but 200% over-collateralization, that's very expensive in terms of opportunity cost. So the over-collateralization is quite an issue with capital inefficiency, because number one, it's going to be hard to scale, and number two, it's actually very costly when you basically have so many opportunities in the bull market today. The 100 DAI that you're giving to the system could be earning like 10x putting that amount of money in other protocols. So that's a small amount of like some limitations that I see, but still, this is a great idea, and I think this is a super cool, interesting system. I don't have any stakes in that. I just think it's interesting and wanted to share with you guys. So if you're interested in more things like that, remember to check out the book that we have, the Token Economics textbook. It's being used in universities now, and I'm working on a version 2 upgrade so that it can be more suitable for MBAs instead of undergrads. We also have a Discord, so follow us on Discord, follow us on Twitter. You can get access to more information. We are also on Substack, we are also on Patreon, we're on LinkedIn, we're on a lot of different social media platforms. So if you're interested in other social media platforms, just Google economics design or just check the links out below. Till then, I'll see you in the next episode. Bye!